I'm Caroline Hyde. This is the best of Bloomberg Technology, where we bring you all our top interviews from this week in tech. Coming up, Apple and Ireland wage war on the European Union over a €13 billion tax bill. Plus, BlackBerry doubles down on software and the move is paying off. We dig into the struggling company's latest report with CEO Chang. An online lender, Sofi, taking it slow after a rough year for Fintech and pushing back plans for an IPO. The CEO joins us ahead. First, to our lead. Apple is challenging its €13 billion tax bill from the European Commission. In a statement this week, Apple said the case, quote, has no basis in fact or law, and we're confident the ruling will be overturned. The fight between Apple, Ireland and the Commission has been building for some time. Speaking to Bloomberg in September, European Competition Commissioner Margrethe Vestager explained why this fight will be a long one.
I think that we will continue to disagree on this decision. Also because of the fact that we have very, very different legal traditions. I have learned that in the US it's absolutely the order of the day for a business to negotiate tax breaks with the state where it's situated. And we have had the prohibition to do that back since '58. So you have the clash of understanding about how this should be played out.
We discussed the latest developments with David Rosenblum, Director of the International Tax Program at NYU Law. He spent years at the Treasury Department covering international tax law, along with Bloomberg contributing editor and Techonomy CEO David Kirkpatrick and Bloomberg editor-at-large Corey Johnson.
The EU say was really interesting because it really explained kind of the history of this tax regime and the different pieces of Apple and which pieces of Apple should be considered Irish, were considered Irish, and which aren't. I think there's two ways to look at the news of the day, and one is whether or not this sort of backwards-looking thing, looking at the way that Apple's paid taxes, might bode differently for the future for Apple and many other companies as it relates to getting taxed in the EU and getting taxed in Ireland. But when you want to understand what happened here, the EU document is a fascinating read. It's a long piece, but it really gets into how this business, Apple was able to claim certain parts of their business weren't really in Ireland, even though some money might have passed through Ireland, and therefore shouldn't have been taxed there because they were going to be taxed somewhere else. And that's really what's at stake here, is what business was Irish and therefore deserved to be taxed in Ireland.
Let's get the lawyer's opinion. Let's go out to David Rosenblum. David, thank you very much indeed for joining us, and give us the sense of Apple claiming they were selectively targeted by the EU here. Do you think they have a case?
Well, yes, they have something of a case. I think that it's true that the state aid investigations have focused to some extent, not entirely, but to some extent on U.S. companies. On the other hand, it's probably also true that U.S. companies have led the world in aggressive tax planning. So I don't find it particularly surprising that the Commission would begin by focusing on U.S. companies.
David Kirkpatrick, weigh in here and give us a sense of your reading of the tea leaves. Are they a view that potentially this is tax warfare going on between the US and Europe?
I don't think it's quite to that point, but I think it's a very confusing situation where, I think Apple has been extremely aggressive, as David just said, and how they structure themselves when they face these tax jurisdictions is an interesting question, and whether it's really appropriate that they should be so fine-tuning of their own structure when they're simply trying to do business around the world. It's legal in the United States, at least. It's turning out maybe it's not legal in Europe. And in a world where these companies have to have a positive kind of carrying of the flag around the world, we may, even as a country, question whether it's to our benefit that they're being so aggressive in other jurisdictions.
But Corey, give us the shareholder's opinion here, because surely for many, the shareholder would say, look, it's in the chief executive, it's the company's obligation to prioritize profits here.
I think what's interesting here is in the context of a Donald Trump presidency, when we might have a big tax repatriation holiday, you have companies like Intel, like Apple and others who have set up a tax infrastructure to benefit from keeping the money overseas, or at least to make the best of that situation. And one wonders if they are so entrenched in these battles and so entrenched in the new organization of their corporate structure, such to minimize global taxes, that the repatriation holiday might not be such a big deal for them, and they might not be so willing to bring cash back because they've found another way to get around these laws.
That's a key question for the next administration. I want to take it back out to David Rosenblum for a second. There is much already under discussion from a global perspective. The OECD had been lining up trying to see how they can tackle perhaps some of the different rules and regulations worldwide and start to get all countries singing from the same hymn sheet. Is that the only way that we can progress forward, is if there is some sort of agreement worldwide between the tax practices?
I think what's missing in the debate, in the Apple debate, and it's partly an answer to your question, a large answer to your question, is the facts. The OECD necessarily reaches consensus at a pretty high level of generality. And the issues come up at a very factual level, so that applying these general concepts to the particular facts at hand is a real challenge. So I don't think it's possible to reach international agreement on the kinds of issues we're talking about. And I might add that notwithstanding the Commission's decision, which was released today on Apple, it was at least I saw it today, 130 pages. It's pretty slim on the actual facts of what happened. It's got a great deal of history about the dispute, about the OECD, about state aid. It's got a lot of legalese and a lot of background. It makes for pretty tedious reading for most people. But I was looking at it to find out what actually happened here, and boy, you look in vain to find out how it was that one of these companies, ASI, booked pretty much just about half of Apple's profits in the year 2015. Commission says Apple had about $54 billion in profits in 2015, and ASI, if I read it correctly, booked somewhere just south of $25 billion.
Yeah, I thought it was fascinating reading for that same reason. I agree they didn't lay it out a chapter and verse, but there was so much great detail in that, and it was interesting to see that they could assign so much profit to that particular region when obviously they had a global business. It wasn't all happening out of Ireland.
What, therefore, is the broader expectation, David Rosenblum, just sticking with you? Who wins out of this particular argument, and what does it mean for Amazon, for Starbucks, for IKEA, for other companies that are currently perhaps being analysed by the European Commission?
Well, in a rational world, and unfortunately we don't live in a rational world, but in a rational world, Apple wins in the dispute with the Commission, because the Commission is advocating assigning all of this excess profit to the branches that Apple had in Ireland. And frankly, the branches that Apple had in Ireland had absolutely nothing to do with earning most of this money. The Commission is looking at the Commission in the United States are looking at the world from two very different perspectives. The Commission sees these individual companies. It sees ASI booking $25 billion, and it says, well, we see a branch in Ireland, and there's no real head office here. And so, therefore, all the profits should go to Ireland. That's sort of what the Commission is saying. The United States sees it completely differently. We see ASI as itself a branch and not a separate corporation. It's part of a bigger company called AOI, which is the top-tier company, which has branches literally all over the world. And so from a U.S. tax analysis of this, it's a much, much, much more complicated situation than the Commission sees. And that's because of profound differences in the way we look at the tax laws. I think you're going to find similar, but not identical, structures of other high-tech companies in other countries, and maybe some in Ireland as well. They're all going to be a little bit different from each other, but they're all going to pose similar questions.
Coming up, we'll hear from BlackBerry CEO Chang as the company boosts its 2017 profit forecast with a new focus on software growth. That's next. And Facebook takes on fake news with a plan to curb bogus stories, but will it work? We head to Italy to speak with Poynter Institute's top fact checker later this hour. This is Bloomberg. A couple of headlines in the auto sector that caught our attention this week, all highlighting how this industry is seeing massive changes thanks to new technology. First, Fiat Chrysler announced the production of 100 Pacifica hybrid minivans, which will join Alphabet's Waymo self-driving vehicle fleet. The minivans will be outfitted with fully self-driving technology, including purpose-built computers and sensors. Meantime, a new study reveals a large amount of motorists actually shut down self-driving technologies in their car. According to Hyundai, about half of drivers turn off their automatic emergency brakes and lane departure warnings, a sign drivers, well, don't fully trust the technology. Nevertheless, BlackBerry is opening a research centre for self-driving cars. The move raises the possibility of government backing for the former smartphone maker's automotive software unit. And speaking of BlackBerry, the company boosted its 2017 earnings outlook and posted an adjusted profit margin for the third quarter of nearly 70%, its highest ever. We caught up with BlackBerry CEO Chang from the company's headquarters in Ontario and asked him, well, whether these margins are sustainable.
A normal growing software company could definitely do better than 70%, yes. But it would take us a while to get there, but it will. It could do it.
How about the software revenue growth? Because you've said that that's going to be about 30% on track for this fiscal year. 30% growth for the next fiscal year, are you aiming for that as well?
Oh, no. Now the numbers are getting pretty big. I think the market is growing somewhere about 10 to 15% next year. We committed that we will be growing faster than the market, and we're reasonably comfortable about that.
I mean, it's always renowned that Angela Merkel always used a BlackBerry, the belief in the security that BlackBerry offers. How, in this sad time of increasing cybersecurity threats and concerns, are you seeing a pickup in demand at the moment?
Actually, I see. I guess in a certain way, that answer is yes. The answer have to be yes. I see a lot of discussion. People try to get their arms around, especially enterprises, try to get their arms around security and cybersecurity. Mobility is one of the biggest vulnerability point. So then this is where we excel. We're the number one player in that space, where mobile meet security. So yeah, a lot of conversation. We feel very comfortable in where we are and where we sit with the customers.
Talk to us about the mobility strand as well. It's interesting you announcing just yesterday, a new research centre in Canada, the focus on automation, driverless vehicles. This is a really crowded space. You're up against the phone makers, well, the software makers. You've got Apple and the tech giants, not to mention the automakers as well. How do you fight within this competitive space?
I don't fight with them at all. First of all, about a month ago, we announced a transaction or an agreement with Ford Motor Company. We're providing software to help them build the next generation car. I'll let them tell you what the next generation car is. But we're helping them to do that. We have both engineering people helping them. They're using our software. And this is just an example of what the autonomous driving innovation centers are going to focus on. So all the automakers are going to be our customers, going to be our partners. All the tier ones, they're like Denso and LG and Panasonic and Harman, who just got bought by Samsung. It's going to be our partners. They have already been our partner, and we're very proud of the relationship with them. So no, we're not setting this up to compete with the automakers. We're not setting it up to compete with tier ones. In fact, we're pretty embracing very open standard. We want to build the foundation so cars could safely be put together and put on the road.
Automation was something that we've just been discussing, announced yesterday, but just not long ago, we also saw another announcement coming from BlackBerry, and this time it was a licensing deal. You're getting out of the hardware and you're letting a Chinese partner build that. How much are relationships with China at the moment under threat with the new president-elect, Donald Trump? Are you cautiously optimistic or concerned with the direction of US and China relations?
Well, that's a very complex question. So let's just talk about technology for a second. I provide all the software technology where the majority of all the security secret sauce is in. So in that sense, there is no truth in that if I build my phone in China by a Chinese partner, that my phone is not going to be more secure or going to be less secure, whatever the right English is. So our security is paramount. We don't have any issue with that. We control all the software and the security software associated with it. We also have our Knox that manages all these devices that is sitting in Canada. We don't have any interest in outsourcing those things. So anyway, so the net of all that is that I would not be concerned about having us to build a phone with a Chinese company that concerns about security. Now, it's related to what the government, United States government policy is and where the trade issue is going to go end up. It's none of those questions. Nobody really know the answer to it. I heard a little earlier guest talk about that, putting a tariff on developing countries. I assume the guest is referring to China and the current currency manipulation situation, or at least the accused of that. All that discussion going on with the president-elect. I just assume that cooler heads is going to prevail, and we won't get into a trade war whatsoever.
A quick last question. Would you work with the Trump administration like you did with Bush?
Oh, absolutely. I mean, like everybody said, he is the president now, or he will be. And anything that help the country, we definitely will.
That was BlackBerry CEO John Chang. Coming up, Facebook rolling out its third-party fact-checking system to combat fake news. Now it's getting some help from Pointer. We'll speak with its Director of International Fact-Checking next. And coming to a pub near you, the world's first beer brewed with the help of artificial intelligence. Can machines really brew a better beer? This is Bloomberg. Since President-elect Donald Trump met with tech leaders on the 14th, we haven't heard from many of the attendees, and the silence perhaps speaks volumes, since Trump hasn't had a strong relationship with Silicon Valley. Yet, this week, Apple's CEO Tim Cook finally spoke out about the meeting. TechCrunch obtained an internal memo where he explained why he attended the meeting, saying, quote, "We engage when we agree and we engage when we disagree. I think it's very important to do that because you don't change things just by yelling." Now, since the US elections, Facebook's outlook on fake news has evolved dramatically. The company recently pulled a 180, turning to third-party fact-checkers to flag false stories. But is this enough? We spoke with Alexios Mantzalis, Director of Pointer Institute's International Fact-Checking Network, to discuss Facebook's new strategy and Pointer's involvement in it.
The Pointer Institute has, through its International Fact-Checking Network, developed a code of principles for nonpartisan independent fact-checkers. And Facebook decided that in order to be a third-party fact-checker on the social network, you, as a minimum condition, you will have had to sign on to our code of principles.
And so Facebook is the arbiter of who is a third-party fact-checker?
Correct. Signing on to this code of principles, which requires transparency of all kinds, is a necessary but not sufficient condition to be a third-party fact-checker on Facebook.
And many people and those signed up to the International Fact-Checking Network had been pushing for Mark Zuckerberg and Facebook to take these steps. Are the steps that have been announced enough in your mind's eye?
We are in the very early days. I hope you don't think I am dodging the question, but the reality is we're going to have to wait and see a few weeks how this works out. I think obviously there's been a lot of pressure on Facebook to do something. Now it has acted. We need to see how this works out in practice. In theory, we think it's a welcome choice, but it may or may not be effective.
In terms of where it could initially be tackling those stories that are obviously false, but the more misleading articles potentially that become rampant across social media and in fact catch wildfire, do you think that will be able to be blunted to some extent? Will we see those sorts of misleading stories pushed down?
I think it is important, especially in the first stages, and I think both Facebook and the third-party fact-checkers are very aware of this, that the concentration be on the 100% totally fake fabricated stories. The Pope endorsing Donald Trump. Those stories are the ones that did really, really well by the social network this year, and those are the start of where the fact-checking can have an effect. I think when we start going into the grayscale and the half-truths, it will be more complicated, and there are other platforms to do that. I am convinced that this experiment could have already a very beneficial impact if it weeds out the totally fake stories.
And how important is this as we enter 2017? We have had the US election in 2016. We have Germany, France, the Netherlands, a wide range of political events happening next year. How is the Poynter Institute preparing itself?
I mean, I would add in the elections of this year as well, the Brexit campaign, the Italian election. Myself, I'm Italian. In these campaigns, we have seen a lot of totally fake stories do really well on social media. In the Italian case, it was ballot boxes allegedly stuffed and 500,000 votes found in an imaginary town, and that was one of the most engaged with stories on Facebook. So I think this is a problem of international scope, and I believe that Facebook is looking to roll this out internationally. Of course, the Poynter's International Fact-Checking Network has members from across the world, and they are all eager and keen to see this rolled out cautiously and carefully, but in other markets beyond the United States too.
That was Alexios Matzalis, director of Poynter Institute's International Fact-Checking Network. Now, the world's first beer brewed with the help of artificial intelligence is on sale in the UK. 4 beers have been created, with each recipe altered based on customer feedback through a mobile app. Bloomberg's Adam Satariano went to find out, well, if machines can really brew a really great beer.
How do you like your beer? Hoppy? Bitter? Dark? Brewers for hundreds of years have been trying to find the perfect recipe. But could it be computers can do it better?
We were just talking over beer about how can we use data more constructively when we were looking at our beers, and we just thought, hang on a minute, it's staring right in front of us.
That's Hugh. His epiphany led him and his friend to develop an algorithm that turns customer feedback into better beer. The process goes something like this. A website printed on the back of the bottles directs drinkers to a survey that asks them a bunch of questions about their taste preferences. The AI bit comes next.
That data, it just goes into our reinforcement learning algorithm, which is called ABI, which stands for Automated Brewing Intelligence. And then the algorithm essentially takes all this information and then comes up with a recipe and gives the brewer a recipe.
Enter the very human brewer, who acts as a last line of defense if the AI goes rogue.
And most of the time, it is bang on. Most of the time, it can be something that actually is brewed. It will every once in a while throw us a completely random thing at us. Some of it is just not possible, and that's where there is that still have that kind of human aspect to it.
Humans brew the beer and drink it too.
It's salty, kind of like seawater with cranberries.
Yeah. I don't think it's very nice.
If you use an algorithm, I think the point is, won't it come out tasting in the middle of the road?
It was obviously not going for the average.
I'm liking it more and more that I drink it.
Yeah,
I mean, I'm
Customer feedback. It can be fickle. But the technology points to a future of tailoring products to the people who use them.
There you go, I've done it. I'm part of something.
In the future, this same technique could be used for other highly emotive products. So think coffee, chocolate. The one I really like is perfume.
So get ready. In the not too distant future, you could be able to give your feedback on just about anything, for what that's worth.
Bloomberg's Adam Satariano reporting there from London. Still ahead, unicorn valuations. Will we keep seeing valuations skyrocket into 2017? We'll hear from one investor who isn't so sure next. And if you like Bloomberg News, check us out on the radio. You can now listen on the Bloomberg Radio app, Bloomberg.com, and in the US on SiriusXM. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Caroline Hyde. Now, as 2016 winds down, views on tech's massive valuation are diverging. Some believe Uber and Snap's value is fair, and others warn of a bubble. My colleague Emily Chang spoke with Accolade partner Atul Ruski about just that. Take a listen.
I do believe, and I agree, that we're at the highest level of fund formation and company formation, but at the same level, I think we believe we're at the highest level of innovation and disruption, and I think that's going to continue going forward. A lot of these companies will not be able to be funded going forward, but the few that do, there'll be a subsection of them that I think are going to create interesting things that really change the way we work and operate.
Now, a lot of companies have delayed going public. Valuations have soared. There's been a rise of unicorns, so-called unicorns out there. How do you feel about that?
Yeah, our belief is there should be fewer instances of unicorns out there, primarily because majority of the M&A happens under $1 billion and very few companies are going public. So if a company expects or plans to be a unicorn, there better be a high probability that they can go public given their business model and unit economics. Otherwise, if their growth moderates, which happens to every company eventually, and they're not profitable, they won't be able to go public, their valuations will get crushed. And as we look at the past few years, it feels like there's been more of a focus on optimizing valuation versus exits. So we hope that changes going forward.
That said, you guys are investors in a number of venture capital funds, including Andreessen Horowitz and Excel,
yes.
And they've got a lot of unicorns in their portfolio. Does that concern you?
So if you look at the top 10 VC firms, they've had a unique ability to invest in these iconic elite companies, whether it be a Facebook, a Pinterest, Airbnb, WhatsApp, Uber, and Lyft. So for those managers and for those companies, there is a market for those companies to go public. But for the broader venture community, unless you are in those iconic elite companies, I believe, or we believe, that M&A is the most likely outcome for those portfolio companies.
Andreessen Horowitz is one fund in particular that's made a big splash, though there's some controversy about how good their returns have been so far. Do you have any concerns there about the performance of Andreessen Horowitz?
So we don't have any significant concerns. I mean, we see the numbers. They've delivered very good returns over the course of the firm's life, partly because they've been able to invest in some of the elite companies I just mentioned. So we're very bullish on them. When they entered the venture capital game, they really changed the dynamic by offering services such as recruiting, PR, and even sales pipeline by introducing strategics to companies. And so almost on a daily basis, they'll bring strategics, Fortune 50, Fortune 500 companies to meet their portfolio companies. And for a number of them, those introductions have become a significant portion of their sales pipeline. So as you talk to entrepreneurs, that's a game changer. And we hear that over and over again. So overall, we've been very pleased. They've had great returns. They've invested in some of the iconic companies, and they are really changing the way venture capitalists operate. And you're seeing other firms mimic these types of services that they're offering.
I'm curious how you decide which venture funds to invest in and how venture compares to the other sectors that you're focused on.
Yeah, so we invest in a mix of venture capital and growth equity, and within that some buyout, primarily technology and some healthcare. When we look at venture capital firms, we are modeling 5x plus funds. And that's because on the growth equity and buyout side, a number of our managers have delivered 3x net funds to us with shorter timeline to liquidity, lower risk. So for venture capital, we are looking for 5x plus funds due to the longer timeline to liquidity and the increased risk.
Now, banking giant Wells Fargo is charging into the biggest asset management battleground, exchange-traded funds. The San Francisco-based bank is considering launching its first ETF sometime next year. But is it too little and is it too late, as its competitors already have a major leg up in the $4.1 trillion ETF market? We caught up with Bloomberg News' reporter Danny Berger and Bloomberg contributing editor and economy CEO David Kirkpatrick from New York.
Well, I mean, listen, this is a struggling time for active managers. They're seeing an immense amount of outflows, and inflows are going into passive investing, going into ETFs. And specifically, it's this new breed of ETFs that Wells Fargo is looking at that's really taking off. I mean, this is the hot new product. So if Wells Fargo wants to be part of the next generation of investing, this is something that they're going to have to be in. And frankly, a lot of people are surprised that it's taken until this year, well, actually next year in the next 3 to 6 months, that Wells Fargo is going to launch one of these products.
And they are trying to differentiate themselves through quant strategy. Talk to us about the way in which they're trying to have a bit of a USP here.
Right, okay, so we got to break it down about these types of ETFs. So these are quantitative-based ETFs built around computer algorithms. So first you have what's called a smart beta that takes the idea of ETFs, but doesn't use market cap weighting. Instead it says, I'm going to pick the stocks with the most momentum. I'm going to pick the cheapest stocks. From there you go to multi-factor, which takes those things and just lumps them together, says, I'm not going to just use one of these factors, I'm going to use a couple of them. So this is really an idea whose time has come, and this is where Wells Fargo is entering in. So if you look at this chart here, I mean, you can see that still assets are growing, but not as much as smart beta market as a whole. Goldman Sachs really has the lead here. So that's going to be their biggest competition. But they're hoping by getting into this front, which definitely is the newest of ETFs, they can differentiate themselves from what's already out there.
So maybe a bit of a me too coming from Wells Fargo, but David, you like the fact that ETFs are catching on, right?
Well, what I like is that to apply algorithmic approaches to tools that ordinary investors can get access to, because these are the kinds of techniques that have really been confined historically to the highest net worth individuals, the biggest institutions. And this is a great way for ordinary people to invest in a much more sophisticated fashion, basically allowing the software to assemble packages of stocks that really wouldn't historically be assemblable, because when the software is selecting for all these different variables, it can do things in real time that are much more sophisticated. So it's not just an ETF that's, grocery store companies. It's an ETF that is companies that have gone up in certain conditions and gone down in other conditions and that are in relation to something else. And I think that's a great thing.
And to David's point, I think that's really compelling for these companies. AQR, the quant fund, had a really great report taking some of the best investors over the years, taking Warren Buffett's, and they found that you could actually break it down using algorithms. So people before who would have never dreamed of being able to have an investor working for them like Warren Buffett, they can now buy these products and essentially get the same returns.
So active versus passive the war continues to wage. Does it surprise you, David, San Francisco-based bank being the last one in terms of the tech foray into ETFs? What do you think made Wells Fargo miss a trick, and where do you stand on the whole fintech
I don't know.
process?
Talking about Wells Fargo is sensitive because they seem to have made a bunch of mistakes in recent years in their larger business. So it is interesting that they would not have been in the sort of advance of this kind of whole movement, given that they're in the thick of the tech community out there. But there's a lot of startups that certainly are pressuring companies like Wells Fargo, and I'm glad they're finally responding. I think we're going to see a ton of innovation coming from tech when it comes to investing.
Coming up, Twitch is taking on the heavyweights of video streaming, Facebook and YouTube. That's as the company looks beyond gaming. We'll catch up with the CEO next. Plus, Sofi CEO Mike Cagney lays out his IPO timeline and discusses what's in store for global expansion. This is Bloomberg. SoftBank CEO Masayoshi Son is making good on his $50 billion promise to the US. SoftBank will invest $1 billion in OneWeb. It's a broadband access company as part of a pledge to President-elect Donald Trump. The investment is expected to create almost 3,000 new engineering, manufacturing and support jobs in the US over the next 4 years. The satellite startup said it raised $1.2 billion from SoftBank and existing investors. Now, another one of SoftBank's recent investments was with marketplace lender Social Finance, better known as Sofi. The San Francisco-based company is now on the hunt for additional funds, aiming to raise about $500 million in equity. Founded back in 2011, the company is one of the fastest-growing online lenders. We caught up with Sofi co-founder and CEO Mike Cagney. Take a listen.
It was wonderful to get SoftBank support and some of our existing investors like Third Point and so forth. And essentially what we're doing with the money is using it for the balance sheet. I think one of the things we learned in market-based lending in 2016 was the need to have a balance sheet, need to be able to originate during periods of market dislocation. And we certainly benefited from having that capital on balance sheet in 16 and continue to expand that as we're profitable and accreting the balance sheet today.
And is that why you're raising more money?
Well, we're raising more money in part because we're looking for additional partners that can help from a loan buying standpoint. So one of the biggest challenges we have is the balance sheet challenge in terms of where we place production. So in 2017, we'll originate somewhere between $16 and $20 billion of loans. That's a lot of paper we have to place. And so having deep-pocketed relationships with investors that are in the business of buying loans is helpful, and that's really a catalyst for the round.
We were just talking now how you started off in student loans but have then moved into new products. It's mortgages, there's life insurance. What other products will you bring online when you get to this new financing?
Sure. So today we're very heavy on the credit side. So mortgages, personal loans, student loan refinancing. We've started to do wealth management and are looking at how to build out our asset management business. Insurance is an important component to that. But I think in 2017, one of the biggest solutions that we'll bring to market is a deposit account and a credit card. And that effectively allows us to deliver a full service of solutions into our member base so that they really don't need to go anywhere else for what they need from a financial standpoint.
I mean, interestingly, I come from Europe, where I was banking with N26 in Germany. We've seen Monzo in the United Kingdom. We've seen plenty of other startups. Is this where the competition is, or actually is it the competition coming from the banks? So they start to work out that fintech is where they need to get ahead?
So we see much more competition from the banks. I think we're going after a very rich target in terms of that 25 to 45-year-old customer demographic. It's very important to the banks in terms of building those relationships. And so whether it's student loan refinancing or personal loans or mortgages, we're seeing much more bank competition today than we saw a year ago. And it's very important for us to differentiate through our value proposition.
Therefore, your value proposition, say you differentiate it, you've got all these different products. How long until you take the competition to the fintechs in Germany, to the fintechs in the UK? Talk to us about international expansion.
So we're going to do Australia first in 2017, but we've got a path to go to the UK and to go to broader Asia as well. And so it's very important for us to deliver that market, or deliver into that market. And it's the same value proposition. It's being able to deliver speed and convenience and alignment and transparency, something that's missing in a lot of these markets for this millennial type customer.
I mean, what you've done in terms of setting yourself apart is help foster the careers of some of these students. You know, you've got the entrepreneur meet and greets. People come around to your house and get to understand you and be given advice. How do you scale that? And indeed, how much is it hurt by when you've got things like Lending Club not doing quite so well in the press? Does that hurt you from an investor and a consumer point of view?
So we have 200,000 members, and if they all came to my house, I'd have a lot of trouble. So we don't do that. But what we do is we do a lot of offline events. We've had about 10% of our member base go to offline events, whether that's career services, where we help people navigate salary negotiations or get reemployed, or the entrepreneur program, where we help people start companies, or our dating events, which are massively oversubscribed for our members, and hopefully they can create more household units that can sell mortgages to out of that. It's an important component of what we do. It's really a part of our differentiation. And what we're finding is the community is beginning to support itself. So people set up these events with our support, but it's not a situation where everyone's coming to my house.
Those are back in the day. But
back in the day.
Talk to me about the regulatory perspective here, though. I'm looking at the United Kingdom, suddenly listening to what's happening in peer-to-peer, looking at what's happening in crowdfunding and getting a little bit worried. And we're talking about the UK, which is actually a very forward-thinking, open regulatory environment. Where do you see regulation changing here and for your business?
So we're optimistic about the regulatory environment over the next couple of years. I think the OCC's initiative to do a fintech lending charter is a step in the right direction. It's one where we can move away from the disparate state regulation that we have today and do a unified national regulator. And we hope more of that comes as the regulators get more and more comfortable with the industry and comfortable with the people involved.
IPO 2017?
Well, I always get in trouble when I say when the IPO is coming. So I think we definitely want to go public. It's important for the business. I think that today we have the luxury, being profitable and growing at the clip that we're growing at, we have the luxury to determine when we do that. And we'll do that when it makes the most sense.
Sofi co-founder and CEO Mike Cagney there. Now to Twitch. Stepping into the video live streaming gold rush, the Amazon-owned video platform is looking beyond gaming and branching out its streaming offerings. In so doing, it's taking on some heavy competition from the likes of Facebook and YouTube. We caught up with Twitch CEO Emmett Shear and asked him, well, about his expansion beyond video gaming.
We're always, I think, going to be video game-centric culture at Twitch, and we've always going to love video games, but we are super excited to expand the platform and welcome a broader array of creators to use the technology we've built to become part of our community.
You've got about 2 million per month creators. How will this expand? Are you just using the creators already out there and expanding their knowledge base and their variety of scope, or is it actually attracting new people to the platform?
Well, we've been experimenting with the creative category on Twitch for more than a year now. And what we've discovered there is that while there's a ton of crossover, you do see lots of gaming creators also wanting to do arts, also wanting to do comedy, wanting to be artistically creative. You also see new people coming in who've never created before and who now feel like, oh, here's a place for me. So it really is a mix of both. There's slightly more people crossing over from the existing community than coming in, but on the other hand, we have a lot of people in the existing community. So I think in the long run, we will see a ton of new people creating, and that's our goal. We'd like to get a lot of new people creating on the platform.
And how do you go about doing that? Is it investing in marketing? Is it going via the Amazon platform, of course, your owner?
So we mostly focus on the product. We like to think that the product should speak for itself, and that we want to have a great product for creators that makes sharing the video, sharing your passions really fun. But the other thing we do is we invest really heavily in a team we call partnerships at Twitch. And the partnerships team's job is to go find great streamers, recruit them to the platform, help them grow, help grow them to the point where they could become a Twitch partner, which would mean they have the opportunity to monetize their channel and they get access to special events at Twitch. And so I think that we try to have the great product, and then we try to make sure we're out in the community evangelizing it.
How does Amazon react to this and want to use this within its platform?
So we work really closely with Amazon when we can find an awesome thing to do with them. I think the most prominent thing we've done with Amazon is Twitch Prime. Mm-hmm. Twitch Prime is a Twitch-oriented part of Amazon Prime. Comes with all the Amazon Prime benefits, free shipping, Amazon Video, but also on Twitch benefits. That's been awesome for our creators. It's helped drive a lot of money into their pockets. It's also been awesome for our customers because Amazon Prime is a great product, and the Twitch add-ons we've added have been really great. But we try not to force it. So outside of gaming so far, we're still in the learning phase. I'm absolutely positive that as we grow it, we'll find amazing things to do with Amazon. But we're still focused on growing that nascent community.
The community that you have already that have so loved you for the gaming side of things, are they worried about the expansion? Are you worried about perhaps losing your USP? We
really did worry that when we started expanding beyond gaming, whether our community would embrace that or not. And the awesome thing is that they have. We recently ran a survey to ask people, what do you think about Twitch adding non-gaming content? Should we? Do you think it'll be good for the platform? And more than 70% of our creators either agreed or strongly agreed with the statement, I think Twitch adding more content than just gaming will not only be good for me, but good for the whole platform.
That was Twitch CEO Emmett Shear. Still ahead, we take a look at which tech gadgets are set to be the holiday winners this season. And a reminder that all episodes of Bloomberg Technology are now live streaming on Twitter. Check us out on @Bloomberg Tech TV, weekdays 5 p.m. in New York, 2 p.m. in San Francisco. This is Bloomberg. This holiday season, as the all-encompassing smartphone has become the dominant electronic for consumers, we take a look at which other gadgets that could be the biggest winners and laggards of the season. With the smartphone becoming a one-stop shop for all our scheduling, photography and fitness tracking needs, other tech gadgets are having a hard time gaining traction this holiday season. GoPro and Fitbit have already both cautioned investors by lowering their holiday sales forecasts. Back in September, Fitbit rolled out 2 new wearable devices, the Charge 2 and the Flex 2. Yet soon after, the company issued weak holiday sales guidance, and the stock lost a third of its market value as a result. According to Gartner, about 30% of people in the US, UK and Australia who had ever worn a fitness tracker no longer use the device. This was followed by GoPro in November telling investors it expects a lousy holiday season, and then recalling 2,500 of its new Karma drones. CEO Nick Woodman defended demand for his products.
There's a misconception that demand for GoPro has been waning with consumers. I say it's a misconception because sell-through at retail has never been better.
Once darlings of Wall Street, both Fitbit and GoPro are young hardware companies that have fallen short of their promise. Now, virtual assistants like Amazon's Echo and Google Home are jumping in to compete against smartphone personal assistants this holiday season. Oppenheimer estimates nearly 10 to 12 million Amazon Echo and Google Home virtual assistants could sell during the holidays, painting a potentially rosier picture for the devices than GoPro and Fitbit are offering.
Let's talk tech gadgets a little bit more for the holiday season. Mark Gurman, Bloomberg Technology consumer tech reporter with me. First of all, which home gadget should I get to solve all my ills when I'm at home?
Well, there's really two options at this point. It's the Google Home, which just came out a few weeks ago. And then there's the Amazon Echo and that whole array of Dot devices. They also have the Tap. It really comes down to which ecosystem you're in. If you're on an iPhone ecosystem, you can, tap into both. You can use the Echo with an iPhone, you can use the Google Home with an iPhone. If you have an Android phone, like the new Pixel, you'd probably want to get the home device from Google because that really could take advantage of some of the Android functionality, the whole Google ecosystem.
If I was perhaps a bit of a gamer, or even an artist, I was at the Facebook Christmas party playing away with some of the VR. Should I be getting into virtual reality? What's already out there that I can purchase this holiday season?
Right, I think VR is super early. Currently the Facebook Oculus Rift, you need to hook it up to a PC. It's this big endeavor. If you're not really a big fan into the VR stuff, if you're just a consumer like you and I, or I'll just speak for myself, I wouldn't have one, right? I wouldn't want a big PC. But over time, those things are gonna shrink. You're gonna be able to wear them, buy them off the shelf, fine. But in terms of being a consumer, the HoloLens is a bit of a smaller kit than the Oculus Rift, but Google has their own. It's sort of this fabric headset. It's less than $100. You can connect it to the new Pixel phone. That is where consumers are going to get a VR, AR experience for the time being. I think over the next 2-3 years, we're going to see more advanced VR equipment from other companies appear. We already reported that Apple is working on their own AR, S glasses. So there's a lot to come.
Talking of Apple, they're looking more at VR. They're looking more at the inside of cars. They're focusing on their iPhone. One key product you're writing about that they seem to have taken their eye off the ball on.
Yeah, that's right, the Mac, right? Is that what you're referring to?
Yeah.
We had a big story today about the Mac. I'm sure you read it. And there's a lot of detail in there that the Mac is sort of taking a back seat to iPads, iPhones, Apple Watches, other products. Given that the Mac is only 10% of Apple revenues, while the iPhone and the iPad combined for over 75% of Apple revenues in this 2016 fiscal year that just ended, it makes some sense.
Yeah.
But don't forget that Mac users are a key group of people, professionals, creatives, that really rebounded Apple out of the brink of bankruptcy in the late 1990s. So it's an important market, and people should expect that a company as rich as Apple and resource-filled as Apple should be able to walk and chew gum at the same time. They should be able to get a new iPhone out the door every year. They should be able to get new Macs out the door, but they've been lagging in the Mac department lately, and people are taking notice.
And so not holding our breath for any update to the MacBook anytime soon?
Definitely not now, at the end of this year. They just came out with the new MacBook Pros in November, early November. But they're planning a few new Mac upgrades for across 2017, a new iMac with some new ports and graphics cards, and faster versions of the MacBook Pro that recently came out, as well as the 12-inch MacBook.
That was Mark Gurman of Bloomberg Technology. Now that does it for this edition of the Best of Bloomberg Technology. We'll bring you all the latest in tech throughout the week. Tune in each day at 5 p.m. New York, 2 p.m. San Francisco, and 6 a.m. in Hong Kong. Tuesday, Raj Ganguly, co-founder of B Capital Group, will weigh in on fintech companies moving from London to Germany post-Brexit. And remember, all episodes of Bloomberg Technology are now live streaming on Twitter. Check us out. It's at Bloomberg Tech TV weekdays. That's all for now. This is Bloomberg.